There is a strange and powerful relationship between global events and financial markets. A conflict in one region, a sudden political shift, a natural disaster, or a financial scandal can ripple across the global economy within minutes. Screens inside trading floors light up with red numbers. Investors begin selling. News alerts spread fear faster than facts. Within hours, trillions of dollars in market value can vanish. To many people watching from the outside, it looks like chaos. But beneath the panic lies a deeper pattern that reveals something profound about how humans respond to uncertainty. We're starting with number 5. Number 5 is uncertainty, the invisible force that financial markets fear more than almost anything else. Markets are built on expectations. Investors buy stocks, bonds, and assets because they believe they can predict future outcomes with some level of confidence. Companies forecast growth. Governments release economic plans. Analysts model future earnings. But when a global crisis appears suddenly, those expectations collapse. No one knows how long the crisis will last, how far it will spread, or what its consequences will be. In that moment, uncertainty replaces confidence. And when uncertainty dominates, the safest decision for many investors becomes the same one: sell first and ask questions later. Number 4 is the speed of modern markets. In previous generations, financial information traveled slowly. Investors relied on newspapers, telephone calls, and delayed reports. Today, financial markets operate in an environment where information spreads instantly across digital networks. The moment a major event occurs, algorithms begin reacting to headlines before many humans even read them. Automated trading systems scan news feeds and social media for signals that suggest rising risk. When certain keywords appear, war, sanctions, economic collapse, those systems can trigger waves of automated selling. What once took days or weeks to unfold can now happen in seconds. Number 3 is herd behavior, a powerful psychological instinct that influences financial decisions during moments of fear. Humans are social creatures, and throughout history, survival often depended on following the group. In financial markets, that instinct still operates quietly in the background. When investors see others selling rapidly, the pressure to do the same becomes overwhelming. No one wants to be the last person holding an asset that everyone else is abandoning. This creates a feedback loop. One wave of selling triggers another. Fear multiplies through the system until the market begins moving less like a rational calculation and more like a stampede. Number 2 is leverage, the hidden fuel that can turn market fear into market collapse. Many investors do not simply buy assets with their own money. They borrow funds to amplify potential returns. During calm periods, leverage can accelerate profits. But when markets begin falling, borrowed money becomes dangerous. If prices drop too quickly, lenders demand repayment immediately. Investors are forced to sell assets to cover their positions, pushing prices down even further. What began as a wave of caution can transform into a chain reaction of forced selling that spreads across the entire market. Before we reveal number 1, pause for a moment and think about how often global crises appear suddenly in history. If you're enjoying this exploration of financial psychology and market behavior, share your thoughts in the comments about what event you think caused the biggest market panic in recent history. And if you enjoy deep storytelling about finance, geopolitics, and the hidden systems shaping our world, consider liking this video and subscribing to Deeper 5. Now, we arrive at number 1. Number 1 is something far more powerful than algorithms, leverage, or even uncertainty. It is trust. Financial markets ultimately run on a fragile belief that the system itself will continue functioning tomorrow. Investors trust that banks will remain stable, that governments will respond to crises, and that economic systems will endure even during turbulence. When global crises erupt, that trust begins to crack. Not always completely, but just enough to create doubt. And doubt can move markets faster than almost anything else. Investors begin questioning whether institutions can control a crisis. They move their money quickly towards safety. Stocks fall. Gold rises. Government bonds surge. Capital flows across the world in search of stability. These movements are not just financial calculations. They are reflections of human fear, human psychology, and the deep instinct to protect what we have built. What makes this pattern so fascinating is that markets rarely panic because the future is certain to be disastrous. They panic because the future suddenly becomes impossible to predict. And in a global financial system built on expectations, uncertainty is often the most powerful force of all. As the world continues facing new geopolitical tensions, economic challenges, and unexpected events, financial markets will likely continue reacting with the same sudden bursts of fear we have seen throughout history. The screens will flash red again. Investors will search for answers again. And somewhere behind every market crash or sudden panic will be the same underlying truth that has shaped financial behavior for centuries. Markets are not just systems of numbers. They are systems built on human emotion. And when the world outside those markets becomes uncertain, the human mind often reacts long before the economic facts become clear.